In the high-stakes world of global finance, certain reports are released that change the landscape forever. For years, silver has been the overlooked stepchild of the precious metals market, trading in the shadow of gold and frequently suppressed by massive paper selling on the futures exchanges. But the silence has been broken. Bank of America, one of the most influential financial institutions on the planet, has released a bombshell research paper that has sent shockwaves through the investment community. This is not a conservative estimate of $30 or $40. We are talking about a mathematical roadmap to $309 per ounce. To many, this number sounds like a fantasy. But to the analysts at Bank of America, led by metals strategist Michael Widmer, $309 is the logical conclusion of a market that is currently breaking under the pressure of a massive physical shortage and a geopolitical realignment. Today, we are going to dive deep into this report, examining the data, the supply deficits, and the historical ratios that suggest we are entering what the bank calls the Mania Phase. To understand how silver reaches $309, we must first understand the concept of the gold-to-silver ratio. For centuries, this ratio represented the relative value between the two primary precious metals. In ancient times, the ratio was often 12-to-1 or 15-to-1. In the modern era, however, this ratio has been pushed to extreme levels, sometimes exceeding 80-to-1, meaning it takes 80 ounces of silver to buy a single ounce of gold. Bank of America points out that during periods of extreme monetary stress or commodity bull markets, this ratio violently reverts to its historical mean. The $309 target is based on a specific historical precedent. In 1980, during the last great silver explosion, the gold-to-silver ratio collapsed to 14-to-1. Bank of America's current macro outlook projects gold prices climbing toward $4,500 per ounce as global debt spirals, and central banks move away from the US dollar. If gold hits $4,500 and the silver ratio reverts to that 14-to-1 level seen in 1980, the math is inescapable. Silver hits $321, with $309 being the critical institutional support level. This isn't just speculation. It is a calculation based on how markets behave when trust in fiat currency evaporates and physical metal becomes the only true safety net. But why would the ratio collapse so dramatically now? The answer lies in a structural deficit that has been building for over half a decade. We are currently in the fifth consecutive year where the world is consuming significantly more silver than it is producing. According to the Bank of America report, the global silver market is no longer in a state of balance. It is in a state of emergency. For years, this gap was hidden by drawing down massive stockpiles in the London Bullion Market Association and the COMEX vaults in New York. But those vaults are being drained at an unprecedented rate. We are approaching a moment that analysts call Vault Zero. This is the point where the registered silver, the metal actually available for delivery to traders, hits a level so low that the exchanges can no longer guarantee physical fulfillment. When Vault Zero is reached, the paper price of silver becomes irrelevant because no one is willing to part with their physical metal at that price. This creates a melt-up scenario where the price must rise exponentially to entice holders to sell. The supply side of the equation is equally dire. Most people assume that when the price of silver goes up, miners will simply dig more out of the ground. But the Bank of America report highlights a critical flaw in this logic. Most silver is produced as a byproduct of mining for other metals like copper, lead, and zinc. This means that silver supply is inelastic. Even if silver prices double, a copper mine cannot suddenly produce more silver if the copper market is sluggish. Furthermore, the world's largest primary silver producer, Fresnillo, has recently shocked the market by cutting its production guidance for 2026. If the world's biggest player cannot maintain its output, where will the metal come from? Adding fuel to the fire is the geopolitical shift coming from the East. China has realized that silver is a strategic asset for the future of technology and energy. In early 2026, China implemented significant export restrictions on refined silver. For decades, the West has relied on a steady flow of metal from Chinese refineries to balance the markets in London and New York. That flow is stopping. China is hoarding silver because they know they need it for their own industrial survival. They are moving away from a dollar-based economy and toward a resource-based economy. When the world's largest consumer stops exporting and starts hoarding, the price discovery mechanism in the West begins to fail. This leads us to the industrial engine driving this mania, the green energy revolution. Silver is the most conductive element on the periodic table. It is not optional, it is essential. Every solar panel requires silver paste to function. As the world pushes for a carbon-neutral future, the demand for solar infrastructure is growing at an exponential rate. Current projections show that the solar industry alone could consume nearly 100% of the world's silver production within the next decade if production doesn't increase. But it's not just solar. The electric vehicle industry is a massive silver consumer. An EV uses nearly twice as much silver as a traditional internal combustion engine vehicle due to its complex electronic systems and battery management units. Then there is the rise of artificial intelligence and 5G telecommunications. AI data centers require massive amounts of high-end semiconductors and electrical connectors, all of which rely on silver. We are witnessing a collision between an old-world mining industry that is exhausted and a new-world technology sector that is starving for silver. This creates inelastic demand, where companies like Tesla, Apple, or Samsung will be forced to buy silver at any price to keep their production lines moving. The Bank of America report also addresses the elephant in the room: market manipulation and the paper market. For decades, the price of silver has been suppressed by the sale of paper ounces on the futures market. Large bullion banks would sell contracts for silver they didn't actually possess, artificially increasing the perceived supply and keeping the price suppressed. However, Widmer's report suggests that the physical reality of the market is finally overwhelming the paper games. As industrial users and sovereign nations demand physical delivery, the exchanges are facing a short squeeze of historic proportions. When the holders of paper contracts realize there isn't enough physical metal to back their claims, they will scramble to cover their positions, leading to a vertical price spike that could easily blow past $100, $200, and toward that $309 target. From a macroeconomic perspective, the timing for a silver mania could not be more perfect. Global debt is at an all-time high, and inflation remains a persistent threat to the purchasing power of every major currency. Historically, silver has been the poor man's gold, the asset that ordinary people buy when they lose faith in the system. But as gold prices climb toward $4,000 and $5,000, silver will become the wise man's asset. As retail investors around the world realize that the silver market is tiny, roughly 1% of the size of the gold market, the influx of even a small amount of capital will move the price with incredible violence. Bank of America is essentially telling investors that the discovery phase is over and the mania phase has begun. This is the period in a bull market where the gains are the largest and the most rapid. It is the period where the general public finally realizes what is happening and rushes in, creating a feedback loop of higher prices and higher demand. In summary, the road to $309 is paved with cold, hard facts. It is paved with the reality of empty vaults in London, export bans in China, and a mining industry that can no longer keep up. It is supported by the mathematical necessity of the gold-to-silver ratio, returning to its historical norms. While the path will be volatile, the destination seems increasingly certain. Bank of America's report is more than just a price target. It is a warning. It is a warning that the days of cheap, abundant silver are over. We are entering a new era of resource scarcity, where the most conductive metal on Earth will finally be valued for what it truly is, a rare, indispensable, and extremely precious asset. For the investor, the message is clear. The suppression of the silver market is ending, and the fundamental laws of supply and demand are taking over. As the world shifts toward a digital, green, and electrified future, silver is the one element that makes it all possible. When the history books are written about the great commodity boom of the 2020s, the silver breakout to $309 will likely be seen as the most significant financial event of the decade. The question is no longer whether silver will break out, but how high it will go once the paper walls finally crumble. Bank of America has made its call. The data is on the table. The vaults are emptying. The mania is here.